There are two ways to present the cash flow statement: the direct and indirect methods. The direct method shows all cash payments the firm has made throughout a given period. This is the same as so-called cash accounting. If all transactions are recognized when cash is collected or paid, then net income would be equal to the firm's actual cash flow. The difference between net income and cash flow is due to the accrual principle. Revenue is recognized when it is earned, not collected. Costs are recognized when incurred and not paid. Under the direct method, the cash flows from operating activities will include the amounts for lines such as cash from customers and cash paid to suppliers. These are actual cash flows that occur during a given period of time. Let's look at an example of a cash flow statement prepared using the direct method. The top line is cash collections from customers. If we want to compare this item to the ones we see in the income statement, this will be something very similar to revenues. Then we will have cash paid to suppliers, cash paid for operating expenses, cash paid for interest, and cash paid for taxes. The sum of all of these items gives us the operating cash flow of the company. The direct method cash flow presentation resembles the income statement, right? It starts with cash collected from customers and then deducts all costs that have been paid throughout the period under consideration. The direct and indirect methods calculate cash flow from investing and financing operations in the same way. Given that almost all companies use the indirect method, we will take a closer look at it in the next two lessons. This will do for now. Thanks for watching.